This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Well, Paul, welcome to the Human Action Podcast.
Well, Bob, it's great to see you. It's been quite a while since two Hillsdale grads sat down and chatted with one another.
Yes, you're right. I forgot about that bit of trivia.
Mm-hmm.
the few and the proud.
That's right. It's been a busy time. I'm glad that we could do it. In fact, I was just finishing up some of my grades for my homeschoolers, right? We homeschool here and we have a co-op, and it hurts me to tell you that we use this book, Lessons for the Young Economist.
Yeah.
Sadly, it was actually well written. I'm just a little jealous, but they did well.
What are the age? What age did you use it for? Because people ask me all the time.
They're high school students.
Okay. For people who don't get the banter, it's because I have a book that was written for younger people called Lessons for the Young Economist that the Mises Institute put out. There's a free PDF and a teacher's guide, so check that out, folks, if you
there is
haven't
indeed
come across it. Okay, well, what we're talking about today is the inverted yield curve and the relationship to Austrian economics and the fact that that's relevant right now. So maybe, why don't we start at the top, Paul? Just for somebody who they've heard people talk about that, but they don't really know, and at this point they're afraid to ask. What does an inverted yield curve mean?
Well, what's a regular yield curve? Let's just start there.
Sure. Start there.
So, in Austrian economics, we see that interest rates are created by time preference, both on the supply side and the demand side. And so we have these subjective valuations, but there isn't just one interest rate. And so we typically assume away all these other complexities from real life in order to make our theory go. But in the real world, you can loan money out or borrow money for multiple maturities. So it can be as long as 30 years on a mortgage. It might be shorter, 20 years, 10 years, 5 years for a car. In fact, it can be as short as just an overnight, loan. And so these different maturities have different interest rates. And typically what we see is that the farther out into the future you go, the higher the interest rate. And so we call this the term structure of interest rates. And when we abstract risk from all of this, and so we're looking at, say, U.S. Treasuries that have currently zero default risk, because they can always make more dollars, we call that the yield curve. And so the yield curve has the short end, 1 month, 3 months, tends to be at a lower interest rate than going out to the 10, the 20, and the 30. And so it tends to be upward sloping. Now, an inverted yield curve is when the short-term rates are higher than the long-term rates. And what we see is that whenever this happens, that 4 to 6 quarters on average later, we're in a recession. And so that's the bell that's been ringing for quite some time in order to signal what's approaching.
Okay, great. So again, just to paraphrase, make sure we're not losing anybody at the gate here. A quote regular or normal yield curve tends to be upward sloping, and again, that's just graphing. On the x-axis is the maturity, so the real short, it's 1 month, 3 months, or so on, out to 30 years or whatever, and then the y-axis is the actual annualized interest rate. So we're saying, even for a given time period, it's not obviously you get more total interest for a 30-year loan, but we're even saying that annualized percentage rate is typically higher on a 30-year loan. So intuitively, like if you're going to lend money to the government and they don't have to pay back for 30 years, you're going to want a higher interest rate, other things equal, than if you're just lending it to them for a month. All right, so that's the intuition. But
absolutely,
as you're saying, yeah, so that's what people mean by like a quote normally, and that at least since World War II, even earlier, normally like during a regular business expansion period in the economy, yield curves are upward sloping, but sometimes they flip, and the short rates are longer. So, and that's the case right now, for example. That
it is.
Do you want to give some of the numbers? Do you have them at your fingertips? Okay, I
do.
Sure. You want to just tell people
the effective Fed funds rate right now, which is the The rate that the Federal Reserve tries to manipulate is at 5.08 right now. The 3-month is at 5.3. The 5-year is at 3.49. The 10 is at 3.5. The 20 is 3.9. And then the 30 is down to 3.8. So on the short end, we've got 5s. And at the long end, we've got 3s. So that's quite a disparity. And It hasn't been this inverted since the summer of 1981. And that's right at the beginning of that double dip recession in the beginning of the Reagan administration that we enjoyed so much.
Okay, so before we get into like the severity of this particular episode, again, just the big picture is the reason people care about this so much. And by the way, and this isn't an Austrian thing. This is like people in mainstream finance know this. People on CNBC, where people talk about it, and so the pattern is so long as you define it the appropriate way, like it can't just be like the thing inverted for 12 minutes or something, like for sufficiently long. And when you define what do you mean by the spread, so a typical measure is like if you take the 30-year yield minus the 3-month yield on U.S. Treasuries, and it's of sufficient duration, like the monthly data, let's say, and if it inverts for more than a certain period, then not too long, but enough, so it's not just a fleeting thing, then I think it's true to say since World War II, anytime that has inverted the way I just defined, what do I mean by saying it inverted, that has always been followed within 12 to 18 months by a recession, and every recession was preceded within 12 to 18 months by such an inversion, so that there's no false positives, no false negatives. Is that, you okay with that?
Well, I do use the monthly data because that kind of filters out the noise, right? This daily thing and like the 12-minute thing you just mentioned. So looking at monthly data, we can get around that. So once it kind of inverts, it's pretty much the sign. Now, there was one false positive in 1967, but we had 1 quarter of negative growth in that period. And so you kind of need 2 quarters of negative growth to have an official recession. So the relationship holds even though there's one false positive, but there hasn't been a recession without an inversion.
Okay, yeah, right. So even there, the exception that kind of sort of proves the rule that we had a half a recession, if that's the way you want to talk about it, it's kind of, but yeah. So and in terms of macro relationships, and like this is, I don't know of a better indicator than this sort of thing where it's got that kind of a track record.
Absolutely.
Okay, and again, this is like, was it Campbell Harvey was the one, or was it Harvey Campbell? I forget which name is first.
Yeah, he's over at Duke University and he still teaches there. And I think his dissertation was in something like 1986 or
okay, yeah. So I knew it was in the mid 80s. I wasn't sure. Yeah. So he was the one that like really quantitatively put this on the. I don't know. Do you know, Paul? Was this like a thing that traders and the pits knew about before he did it, or was this like his discovery?
It's a little bit of mythology at this point, but I kind of think there might have been some intuition, but he's the one that put it on the map. And as soon as he did that, the Federal Reserve, under a couple of guys there, really started digging into it in the 90s, and that's kind of, but it's exploded since then, right? So everyone just kind of knows it at this point.
Yeah, right. Like when I came of age in terms of financial markets and stuff, it was just common now. Oh yeah, inverted yield curve. But when I went back and looked, so I knew he was in the mid 80s that did like a formal doctoral dissertation on it.
Yep.
But again, I wasn't sure. Did he discover this pattern, or was his task to give a theoretical underpinning and some rigor to this kind of rule of thumb that everybody in the real world knew about?
Yeah, I don't remember the exact timing.
Okay.
It's been a while.
And so now can you Can you explain, Paul, why do I have you on to talk about this topic?
Is it the hair?
No. Well, besides obviously that you're photogenic.
Right. Well, it's because as we were going to grad school at roughly the same time, my topic was on the inverted yield curve and economic recessions. So the question I was asking is why does an inverted yield curve precede an economic recession? And so if ever you are got a case of insomnia, you can go to Mises.org, you can pull it up. It's posted there, and 200 and some pages later, put you right to sleep. So but it's there for you to take a look at.
Right. So notwithstanding the self-deprecation, what the situation so that again, folks, so the mainstream people knew about this relationship, and so I think I independently got interested in this, and then I realized that you did your whole thesis on it, and so since we're coming obviously from the Austrian tradition, it was an interesting question of is
why?
there does this make sense from Austrian theory, or is this some spurious kind of like, oh, well, government deficits cause GDP to grow up. Look at World War II. So, right, yay, Keynes and his Austrians, we have problems with that.
Very much, yeah.
Where, so here I was wondering too, like, are we, and so I think we both independently realized that, yes, this does make sense with Austrian theory. So do you want to talk a little bit about that?
Absolutely. Yeah, so to put this in context, right, we have to think about Austrian business cycle theory, which begins with artificial credit expansion. And this artificial credit expansion lowers interest rates, and it creates a need or a desire for those to invest. And so they not just overinvest, but they also malinvest. And that's the key, is that they're moving resources into the wrong areas of the economy. And when they do this, it puts us in an artificial boom. And so during this artificial boom, you'll have people that say, I can start housing, right? I can build houses. And I think Mises gives an example of a guy with bricks. And so let's suppose there's enough bricks to build 4 houses. Well, can I start 6 foundations? I can start 6, but do I have enough bricks to complete them? I don't. I only have enough for 4. So as time goes on, I've borrowed the money. I'm getting closer to, finishing building these houses. I'm running out of bricks. So I need to get more money to get more bricks. And so as I go to borrow more money, others are also doing the same thing. We're all scrambling for resources. And so this puts pressure on interest rates, because if I don't finish a house, I can't sell anything. If I can't sell anything, my entire endeavor is worth nothing, right? It was all for nothing. So there's a big mad scramble to get these real resources. And so the credit crunch, which is the third phase of the business cycle, either comes about in 2 ways. Either the Fed sees that prices are spiking because I need bricks, you need bricks, and we're all bidding up the price of bricks, and so they slam on the monetary brake in order to decrease the amount of inflation, or we simply run out of bricks and we have a real resource crunch. And so when we look at the upper turning point of the business cycle, this crunch phase, it has elements of both in each case, right? So there's a resource crunch and then there's a credit crunch. The question is which one is the first and which one is second, right? But they're both there always. And so when this occurs, we see this mad scramble for these resources, and that pushes up the short-term rate, because I just need to get those bricks to finish that housing right now. Because if I don't, it's all just for waste.
I guess the element of it, and you alluded to it when you gave the initial introductory explanation, that normally when people talk about Austrian business cycle theory, especially if like they're explaining it to a lay audience, they'll just talk about the interest rate and say, oh, the central bank or the banking system under the leadership of the central bank floods the market with unbacked credit that pushes our interest rates down to artificially low levels, that causes a boom. Then they realize for whatever reason they want to switch course. They slam the brakes. That makes the interest rate spike. And then the entrepreneurs realize, oh no, we can't complete our projects, and layoffs ensue and so forth. And so, yeah, the insight to like relate it to this empirical pattern is to realize, well, no, there's not just the interest rate. And so then if you ask which types of interest rates does the Federal Reserve in the U.S. have more control over, just about everyone's going to say the shorter term ones, that if the Fed slams the brakes, that's going to cause short rates to change more than 30-year rates. And so that if you just once you incorporate that little subtlety into the standard Austrian story, it totally fits that, yeah, during an expansionary boom, when the Fed pushes down interest rates, it'd be on the short end. So that would make sense that short rates are lower than long rates. In fact, long rates might even go up if they're just pumping a bunch of money in because people build in higher inflation expectations.
That's a little bit of the case too, yes.
So, and then, the flip side, when they slam on the brakes, that would tend to have, more of an impact in the, short term. Okay, so again, that pattern fits that you would see a quote normal yield curve during an expansionary boom in the Austrian taxonomy, and the other thing, Paul, is what's funny, like when you ask the standard Keynes, like when Paul Krugman writes on the yield curve, the explanation he gives is that, and here it's not like he's inventing that this is standard in this literature, but so there's different theories as to explain this pattern, and the one that he latches onto, like in his New York Times columns in his blog, is that people see a recession's coming, so they forecast that soon in the future the Fed's going to slash rates because we'll be in a recession, and everybody knows when there's a recession the Fed cuts rates, short-term rates, and so that's why now, rationally looking ahead, we forecast that short rates are going to plummet. So that's why long rates right now start dropping. And so that would explain, if that were true, yes, that would show, right, like a little bit before you enter a bad recession, you would see long rates plummet and then the yield curve would invert.
Yeah, but that's not what happens.
But empirically, that's not what you see. Yeah. You see that what tends to happen is right before a crash, the short rate zooms up above the long rate. The long rate doesn't come down until once the crash is underway.
Absolutely, yeah. The long rates don't move all that much at all. So yeah, he's got his empirics wrong.
Well, I just think he didn't even check. In other words, he didn't have enough subtlety or nuance. If all you had to look at was a chart of the spread, like if you went to the Fred data set, did 10-year minus 3-month, and you would see, right before recessions that goes negative. Yep. And then his theory would make sense of that. But then when you decompose it and look at the level of the 10-year and the level of the 3-month, then you see, going into a recession, it's not that the 10-year collapses, it's that the 3-month spikes, which again is totally consistent with the Austrian story that it's the monetary authorities slamming on the brakes and causing a tightening of credit. That is what tips us.
Well, I think we've moved into a new monetary regime with the Fed and how they are manipulating the yield curve, because they have done target asset purchases. They have done this quantitative easing. They're fully aware of the signal, and they are trying to prevent the yield curve from inverting because they think that if they can stop the signal, they can stop the recession, which is just crazy. And so what the Federal Reserve has done is it has taken the reserve ratio, right, the reserve requirements that they've asked banks to hold on to, and they've plummeted it all the way down to zero. And so the reserve ratio is currently at zero, and it's been that way since March of 2020. So that means the money multiplier isn't 100; it's theoretically infinity. And so then they've pushed just tremendous amounts of money into the system. And so now what they're doing is they are applying interest. They're giving interest to banks just on their deposits at the Fed. And so that's called interest on reserve balances. And so the banks have all of this extra cash, and it kind of places, so if we're looking at the loanable funds market, it places a floor underneath the banks. And so the banks aren't even really active in the Fed funds market anymore because they're so flush with cash. And so what we really see happening today is the Fed has opened up the Fed funds market to other non-bank institutions. So money market mutual funds, some government-sponsored enterprises such as Fannie and Freddie, they're all able to get into the Fed funds market. And so the Fed now is able to control both the quantity of money in this market through non-borrowed reserves, and it's placed a floor for banks, but a ceiling for these non-bank institutions. And then it places underneath this, what these non-bank institutions are going to do is that they can't deposit money at the Fed like a bank, but they play a game. And so they created a system as if they can deposit money at the bank and get interest on it at the Fed. And that is our overnight repurchase agreements. And so the overnight repurchase agreement that the Fed sets is now the floor of the Fed funds rate. And that currently sits at 5.05%. The interest on reserve balances is currently at 5.15%. So there's a 10 basis point differential there. And so the effective Fed funds rate sits right in between at 5.08. And so the Fed is able to tightly control the price, the interest rate, and the quantity through non-borrowed reserves of this market. And they think that they've solved the interest rate problem. They think that they've solved the yield curve, and they think that they've solved business cycles. But as you and I both know, there are secondary consequences to all of this sort of infusion of cash, and it has to go somewhere. Now, in the last recession in 2007, 2008, 2009, it went into mortgages and mortgage-backed securities and housing and such. But this time, it's much more diffuse. It's spread all over, right? So you've got some of the money in housing, and you've got banks, because they're not putting it, they're not loaning it out. They're just investing it. And so some of them are investing it in crypto, and we see that with Silicon Valley Bank. And so what we see is that there's not just a bubble like we saw in 2007, but there's a lot of bubbles out there, and it's pretty big. It's pretty huge.
Well, sure. I mean, partly just because if you graph, how much in reserves did the Fed pump in, or you want to look at the Fed's balance sheet, different metrics, what they did, following the 2008 crisis was unprecedented in the sense that they basically doubled the balance sheet in a few months. But then now what they did, back in 2020 and following is even dwarfed what they did back in 2008. So certainly, can you alluded to this early on, but now that we've given more the basics for people, so can you just again, why are we talking about this right now? That currently, so the yield curve is currently inverted, and it's not just that, it happens to be inverted, but the severity of it, or the magnitude, the degree to which the short end yield is higher than the long end. Can you just speak again to that now that people have a better framework to understand the significance?
Sure. So the short end, as we know, was basically zero for an extended period of time. And they've just been pumping money. And now the Fed has slammed on the monetary brake, or is trying to. But it's very, very difficult because you have a Congress that is absolutely out of control with their fiscal policy. They're just spending, and they don't have the money to cover it. And so you have bonds that they're issuing in order to make that covered. But no one's buying our bonds. The Chinese aren't buying our bonds. Russia's not buying our bonds. No one's buying our bonds. So who's buying it? It's the Fed. So the Fed, on one hand, is increasing the money supply through monetizing the debt, and at the same time trying to bring in, inflation through raising interest rates. And so it's raised these interest rates up over 5% right now. And as a result, we see an inverted yield curve that we haven't seen anything like this since the summer of 1981. So it's been a very, very long time. So it's over 40 years since we've seen it this out of whack.
Yeah. So I'm curious your thoughts about. So I've had some correspondents contact me, knowing that I've done work. By the way, folks listening to this podcast, so we'll put a link. Is there a link to your dissertation somewhere?
There is, absolutely. It's at Mises.org, and they can just type in my name, and it will come up, and there's a link to it and all of that.
Okay. Also on the show notes for this episode of the Human Action Pocket, I'll give a specific link, folks, to make sure you can find. But in addition, I'll put my Understanding Money Mechanics book for the Institute. There's a chapter on this stuff. And so, since some people knew that I was, into this topic, they've been contacting me and saying, Bob, I don't know if you've been paying attention, but the yield curve now, this was like a couple months, is more inverted than some of them were saying in history. And then, Paul and I offline recorded it, probably go, at least to the early 80s. And so they were wondering, is it just a matter of yes, no, inverted or not, or the severity or the depth of the inversion? Does that matter? So I said, hey, that's a good question. I never thought about it until you just asked me. But my guess would be, because I'm lining it up qualitatively with the degree of intervention from the central bank, that I would think, other things equal, the more inverted, in a sense, that would kind of show the bigger the preceding credit boom was, and then, you know, to switch over and slam the brakes, that mismatch was bigger, that would cause the, you know, the temporary inversion to go the most. How do you feel about that?
No. No.
Okay, good. Well, see, this is we get some clash. Good. Okay, so explain why.
Okay, so I don't think the size of the boom has to equal the size of the crash, or is an indication of the duration of a recession. And so if we look at the crash in 1929 under Hoover, well, their policies, both Hoover and FDR, took a recession that was milder than the preceding one in 1920-21 and turned it into the Great Depression. The crash in 1920 started in January of 1920, and then we were out by July of 1921. So what was the difference? Well, the difference was on the policy after the crash. And so the policy after the crash happened where in Hoover and FDR, there was intervention. They would not allow businesses to declare bankruptcy. They would not allow the misaligned capital to be sold off and then reslotted into the structure of production. They would not allow the normal liquidation process to occur. In contrast to that, we see the 1920-21 recession. And who was president in 1920? Well, that's Woodrow Wilson, right? Progressive Woodrow Wilson. You're like, wait a minute, progressive Woodrow Wilson? Yeah. So what's the story here? Well, in 1918, the Republicans took control of the Congress, and they said our spending, and you can look up these numbers, but it's roughly, they were spending something like $18 million, and they had revenues of just under $6 million. And so then when the recession hit, they balanced the budget. And so they did that by cutting spending to under $6 million, and they had revenue of just over $6 million. And you're like, wait, how would Woodrow Wilson do that? Well, Woodrow Wilson suffered a stroke. And so he was completely, just drooling into his pillow and wasn't on, protesting this. And so by getting government out of the way, by scaling down the size and scope of government intervention, by scaling back the spending, by pulling them out of the economy, they allowed the liquidation process to occur. And then you see that the recovery, we were out of it in 18 months. So when Warren Harding was sworn in president in March of 21, right? It was just March until July, right? So he really didn't have much, although he claims all the credit. And so if we look at our recessions today, can we take a recession and make it much, much worse? And the answer is absolutely. We can make it deeper. We can make it longer. We can mess it up. Now, one other economic caveat is when we look at capital from an Austrian point of view, we know that some types of capital are substitutable, but other types of capital are complementary in the structure production. So I could be building tables, and so I can be knocking down trees, and lumberjacks are taking them to the sawmill. I can have a lot of demand for tables in the consumer market, but if I only have one sawmill, you see there's a bottleneck in that supply chain. And so the problem is that there's capital specificity that we need in order to convert the lumber into the tables that people want. And so it's not just what type of capital, how much capital, it's what type of capital we have. Now, some types of capital are kind of easy to rearrange. And so if we look at the dot-com bubble in 2000, well, who got hit? Well, the dot-com bubble, you can take a programmer from pets.com, and now I can move them over into some other thing like ESPN.com. And that delay, that transfer of skills and equipment isn't too messy. But if I'm looking at something like housing or other goods that are not substitutable, then that readjustment process might take quite a long time. So when we see that the auto manufacturers in 2008 were having problems, right? What are you going to do with these presses, and these big dies that stamp metal parts, right? You can't convert that into a dot-com industry, right? So the type of capital can help determine the length and the depth of a recession. Now, that being said, government can always make it worse.
Okay, yeah, we're actually not in disagreement on that. I agree with you. And I was, when I talk about the Great Depression, a lot of times people, you'll hear them like fans of the Austrian school say, "Oh, the Fed caused the Great Depression," and you're right. Like I'll be anal and say, "Well, no, technically the Fed caused like the stock market crash of '29." If you want to say that, and the slump, the Great Contraction is how they call it in the early 30s. But the reason, the thing lingered on for a decade is because of what Hoover did first, and then FDR upped the ante.
Absolutely.
So I agree with you on that. But I guess so this time around, though, if like the shock to the system, though, in some sense, could be proportional to the degree of the credit malfeasance, given that I don't think the Biden administration is going to have a radical privatization and tax cut plan that kicks in.
Well, he might be drooling. He might be drooling in his pillow, just like Wilson, right?
right. Yeah, he's just trying to reproduce the good effects. Right. So, I'll just to give people new. And again, you can answer this with whatever caveats you want. So I've been saying, I'm just reading the big picture numbers that I make this qualification too. I said, I don't know that like if you tune into CNBC, they'll know we're in a recession by December. But I think, 2 years from now, looking back, they will classify and say that, yes, either by the end of this calendar year or early, 2024, a recession will have officially begun. And I personally think it's going to be a deep one, the way they judge these things. Are you okay with that? Or do you think that we really shouldn't be speaking with such specificity?
Well, look, the longer the bubble, right, and the more that we pump up the bubble, right, the more misallocation and malinvestment can occur, right? And so we know that the stuff is misaligned. We know this just by looking around us, right? You look at the unemployment rate of 3.4, 3.5%, and yet you go to a restaurant and they're understaffed, right? Now, you go to Home Depot and they're understaffed, and you go to stores and their stuff's still not on the shelves. It's like I thought we were beyond all of this, and so there are these supply chain interruptions, and so it's not just but there's a misallocation, right? So in this structure production, it's out of whack. Now, by how much, I don't know, and where exactly, we can't know that until after the fact, because it would sort of be like saying, oh, that's new money, right? You can't tell the new money from the old money, right? And in the same way, I can't say, well, that's a business prospect that only is occurring because of Fed monetary policy. Otherwise, it wouldn't have, I can't make that sort of differentiation until after the fact. Now, once we see this downturn occurring, that's when our political economy side kicks in, where it says, okay, so what have the politicians done in the past? Well, they've engaged in strong fiscal policy. They have engaged in policies that prop up failing businesses, and they stop liquidation. And we can then use history, such as the 1990s in Japan, to see how they chose the path that would not allow bailout or would not allow bankruptcies, and instead they were just continuously bailing them out. And as a result, what happened was they created an anemic recovery. Then Obama in 2008 did pretty much the same path. And so when we went down, we don't just bounce back and then grow again. We stay down, and then we continue our slow anemic growth after that. And so by these policies that the politicians are doing, we can predict the length and duration and the severity of it, right? So if they don't allow bankruptcies, if they don't allow capital to be reallocated, then and they keep propping up failing businesses, they're just going to make a bad situation much worse.
So I'm in agreement with you on that one, and unfortunately, we may get to see a textbook demonstration of how bad monetary policy interacting with bad fiscal and regulatory policy can yield really bad outcomes. So with that encouraging note, Paul, thank you for being a guest on the podcast.
Bob, it was fantastic. I really enjoyed it.
Thank you for coming, and thanks everyone for tuning in, and we will see you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.